welcome. You're watching Buy Now, Sell Now. I'm with you, Kavita Thapliyal. With me is my colleague, Ankita Saxena. And yes, a show where we answer your stock-specific queries. But before that, we know it's a Q4 earnings season. And joining us is KFin Tech management. And yes, as far as the results are concerned, margins have dipped quarter-on-quarter. Profit revenue has declined on integration and strong year-on-year growth led by global business. But then what's in store? Let's chat up more. We are joined by Mr. Srikanth Nadella, MD and CEO, KFin Technologies. Hi, morning, and welcome to the show. So let's just talk about the revenues first. Revenues, the gap that we have seen between revenue growth, the 19% and PAT growth. How would you like to explain the driving factors over here?
You are aware of the fact that we have completed the acquisition of international fund administrator called Ascent Fund Solutions. That's fledgling, fast-growing fund administrator who's present in 18 different countries. Now, we have completed the transaction in the month of October, and we have consolidated the results ever since. That has added a top-line growth, which is reflecting in the form of 19% that you're talking about is the overall full-year number. For this quarter, it is close to 23%. But obviously, given it is a reasonably new organization, which has just broken even, clearly there has been a downward pressure in terms of margins as we have consolidated the accounts. But the core standalone KFin Technologies, PAT continues to be robust. It's positive. So it is effectively the consolidation effect, as well as clearly there has been a little bit of mark-to-market impact in Q4, given our organization has a symbiotic relationship with what happens in the markets.
Hi, good morning. This is Ankita also joining in. Also tell us what is the organic growth trajectory of the international business post the Ascent normalization. Give us some color on that as well.
Going forward, the year, of course, is choppy. Guessing where the markets head, is anybody's guess at this point in time. I think what we, however, on principles of conservatism, have arrived at. We just completed our annual budgeting exercise, so on and so forth, and we believe that we still have a 24% thereabouts top line growth visibility, with a EBITDA growth around 16% and a PAT growth anywhere around 10 to 11% for the upcoming year.
Let's just talk about the EBITDA. EBITDA margin dropped from 43.9 to 40.7%. Now, what is the steady state margin post asset integration, and can we sustainably return to 43 to 45% range?
Definitely. There is no reason for us to not to be able to. As I said, it is a consolidation effect, not to mention, obviously, the mark-to-market impact that we have seen across the markets for the last good part of the last year, which effectively has a downstream impact in terms of our total revenue, given our commercial model is that we charge in basis points on the assets under management of the industry, which is directly related to the markets as well. We do believe that even in the short term, definitely in the medium and long term, given the financialization story of our country, the overall mutual funds, AUM, the alternative asset classes, the security markets, the secondary markets primarily, will continue to be fledgling. In that context, for us to return to 43 to 45% is, probably 12 months away. That said, we have always been guiding, anywhere between 40 to 45% as a very sustainable number. We may have, 1 or 2 quarters which are entirely dependent and driven by the macros, which can drag the numbers down to 40.7, 41 where we are. But on a sustainable basis, 43 to 45% is something we should be able to get back to in about 12 months from now.
Mr. Nadella, so what percentage of the revenue is now non-market linked, recurring annuity? Tell us about that as well.
India mutual funds business contributes about 58% for our total book, right? That is obviously directly dependent on the markets. Our international business also is dependent on the markets, but of course that is dependent on the global markets and not necessarily Indian markets, and that is exactly the diversification we wanted to accomplish across asset classes, across business processes, and across geographies. So if you add the exposure of the funds that we have both domestically as well as international, that will be close to about 72%.
All right. What is the blend revenue yield across domestic mutual funds, international funds, AIFs, if I have to ask? And also, where is pricing pressure highest today?
See, yield is a factor of multiple things. Pricing pressure is one of the factors. That is not the only factor. The yield, of course, is a number that you compute across the clients, across asset classes. Typically in mutual funds, for example, there is a differentiated rate, depending upon whether it is actively managed equity funds or a debt, or a money market funds or an ETF, so on and so forth. So it is basically average of averages. Discounts driven by pricing conversation is a factor that probably has a bearing of 30 to 40%. The rest of it is asset mix, right? I mean, if there is a disproportionate increase in, say, passives, as we have seen in Q2, Q3, and Q4, thanks to a dramatic rise in the metal-based ETFs, right? Especially the silver and gold ETF, those will have downward pressure on the yield. But by and large, our yield had been reasonably stable. We believe that within probably on an average of about 1 to 1.5% of yield correction will happen every year. Part of it is because of the pricing pressure, part of it is because of the asset mix, and also depends on which of our clients is growing faster than the other, because the pricing is different for each AMC.
Mr. Nadella, also your AUM growth has been around 21%, which is in line with the industry. But how much of this growth has been market linked versus the net inflows and versus the client additions as well?
Most certainly. Our growth this year, it is almost all of it is, thanks to net flows, right? I mean, 21%. There has been, net, mark to market, reduction. So you have to attribute almost all of it to the net flows, which obviously also requires significant efforts on our part in terms of the operations that we, handle and scale. So I take heart from the fact that given what may look like a very bad year in terms of the markets, we still have a 20% uptick in the AUM. Which effectively means that in a good year, what could be, in terms of, what more growth we could see. On the issuer solutions, where we manage the registrar and transfer agency work for listed and unlisted companies, we have grown about, 11% overall for the full year. Now, that is despite a significant exodus of, mass retail investors from the secondary markets. That growth we could still orchestrate on the back of, significant new client wins as well as transitions from our competitors. So with the markets turning around, with the retail investors coming back, we hope to see a much better year ahead in terms of the registry work. In terms of the net new client wins, in the case of mutual funds alone, we have signed 4 mandates this year, 4 new asset management companies, very prominent, very notable ones, and we believe that we have a very strong future with them. Internationally, we have expanded our count quite a bit. With the inclusion of Ascent, we now manage close to 1,000 fund managers across the globe, across 18 different countries. Organically, we manage about 110, 120 ourselves across Asia. And with Ascent across the globe, including Cayman, including Europe and Americas, we manage about 1,000 plus fund managers. So that's a very large scale expansion in terms of the total client contracts we have. On the alternate investment funds, also we have grown by about 25% in line, slightly ahead of the market in terms of addition of the net new funds. That is launch of new schemes as well as the new funds. And National Pension System has been a big win for us this year. We continued for the 3rd year in a row to grow 3 times the speed at which the industry had been growing.
All right, Shrikant, thank you so much for joining in and talking to us on the results today. Thank you. So let's move on and let's shift focus towards the FNO universe. Let's look at FNO 360 powered by 5paisa. Our colleague Sajid has joined us to explain more on this. Sajid, what's happening in the FNO segment today?
I know it's a high pressure day for the markets, and the Nifty hovering around the 23,800 marks with a lot of call writing, which is now coming in at the 23,800 strike as well. The index, as we speak, is down nearly 1.5%, and almost at the day's low there. There is a strong buildup of short positions which is happening in Nifty futures, and that we can see with the jump in open interest by which is up nearly 3.75%. The Nifty Bank again is down 1.56%, led primarily by the PUC banks, and there we have seen a good amount of shorts getting added, 4.4% jump in shorts for the May futures, which is there. Look at the constituents of Nifty Bank there. Most of the stocks, almost all stocks, are seeing some shorts getting built at this point in time, led by HDFC Bank, ICICI Bank and Axis from the private side, and SBI, which is leading the pack from the PSU Bank side, which is there. If you look at how the call and put writers are doing at this point in time, a lot of call activity happening at 23,800, 23,900 and 2,400, with 24,000 being a significant resistance coming in. And if you look at the distribution there, now the focus is shifting a little lower to 23,800 level, where the call writers are adding more positions at this point in time. Currently, there is a hold off which is there, or support which is coming in at that strike, but if call writing continues, we may see 23,800 also break today. Futures gainers include Samman Capital, long positions getting added there. We have Motilal Oswal with some shorts covering. Emphasis is seeing some long positions. All stocks up or nearly 2%. And futures losers, you have stocks like Vedanta. There's a long unwind which is happening. There is the demerger that has happened, the ex-date being today. Waaree Energy, short positions getting added, the stock down 10.6%. Post Motor is down nearly 7% in today's trade. And there's a short position which is getting added there. Open interest point of view, you have stocks which are, like Waaree Energy, which is added nearly 36% shorts, in open interest. We have KFin Tech, which again came out with earnings, adding nearly 16.9% in open interest, and HUL after the earnings is seeing some shorts getting added now at open interest of nearly 10.9%. So HUL is now getting active after the earnings which have been reported. Open interest losers include Vedanta. There is a long unwind which is there, as I said. Motilal Oswal is seeing a short covering, and Bajaj Finance after the earnings that came in yesterday, which were in line, seeing some short covering coming in after the NBFC gave good top line AUM guidance which is coming in. Options, let's look at HUL. 2400 May call, 8 lakh contracts getting added there. There's a premium which has fallen by 23 rupees to 17.35. Stock hovering around 22.40 to 45 at the point in time. Bajaj Finance is the other call option which is very active in today's trade, which is the 1000 May call, where the premium has fallen by 1.5 rupees to 12.7, and 10 lakh contracts getting added in that. The stock hovering around 948. Among the puts, you have Reliance, which is active. The 1400 May put is there, where there's an unwind happening. Their stock is down, and there's a long unwind which is happening. 4.13 lakh contracts getting unwound at this point in time, and the premium up nearly 9.3 to 29 rupees. So overall, the market is critically poised, and if the call writers are going to be more active, you're going to see the breach happening at 23,800 levels going forward. Back to you, Ankita.
All right, Suji, thank you so much for joining us with a roundup of the F&O universe. But with that, it's time for a quick break. Don't go anywhere. After the break, we'll come back and talk more about the market. Stay tuned. Welcome back. You tune in to Buy Now, Sell Now, a show where we get all your stock-specific questions answered. The number is flashing on top of your screens. So start writing into us with the buying price, holding period, and we'll get them answered by a fundamental and a technical expert. And on the fundamentals now, we're joined by Sharmila Joshi, independent analyst, and on the technicals, we're joined by Forum Jada, who's the founder of Chart Analytics. So it's a house full of women now. And with that, let's get going with the show. And first question that's coming on WhatsApp. Rakesh Gupta from Delhi is writing, and he says he's bought 300 shares of BSE at 3,300. Should he hold on to it or should he sell? He's not given his holding period though, but I'm assuming he wants to sell it right away. He's bought it at 3,300 and currently obviously sitting at a profit. Forum, coming to you, all these capital market, the entire capital market theme has done very well for itself, including BSE. Do you see more upside to it, or should he really sell and probably book his profits?
And thank you for having me. Well, BSE has been one of the outperformers if we see overall compared to the other stocks also. Having said that, the overall trend of BSE does remain on the bullish side. So one should look at holding it even from an investment perspective. Assuming if he's been holding from a short-term time frame, then I think he should look at maintaining a trailing stop loss below the levels of around 3549 and look for the stock price to rebound back again towards the levels of around 3630 to around 3650, where he can consider booking partial profits because there are multiple targets on the upside. The second target I would recommend is more of 3700.
All right, but a stop loss of below 3549, and that's the advice on this particular counter. Let's move on. We are joined by our viewer from Thane, Sudha. Hi, morning.
Yes, good morning, ma'am.
You can ask your question. Our experts can hear you.
Yes, shall I repeat my query?
Yes, you have bought 1,000 shares of Jio Finance.
Right.
Okay, and?
I want, and then Godrej Agro, I got 200 shares.
Okay.
And IIFL 200.
Okay. Can you please tell me the buy price of all the counters?
Yes, madam, it is Jio is 284.
284
Godrej,
Jio.
284. Godrej is 647.
Okay.
And IIFL is 450.
4-5.
Sorry, 535.
535. Okay. So this is a short-term or a long-term view?
It's a long term, 3, 4, 5 years.
3 to 5 years. Oh, fantastic. Sharmila, your advice?
Which were the three stocks again? One was Bajaj Agrovet, one was IFL Capital or Finance?
It's IFL Finance.
Finance. And the third stock is?
Jio.
So Jio is outright a hold for me. I think both IFL Finance and Jio I would recommend to hold. Simply because, the one sector that we've seen has done reasonably well in these last 5-6 months is the financial services space. And Jio has a lot of new things that they will roll out. So it's a stock where you, I think, haven't really done the full discovery of what the potential could be. So I think, since you're a long-term investor and you're talking of 5 years, it's for me, that's a definite hold. So also IFL Finance, maybe to a lesser degree than Jio, but at this price, I think it's a hold. And lastly, we have Godrej Agrovet. We have been hearing from the Godrej management about their sort of, the new ventures they want to get into and where they want to take their existing businesses to. So they seem to be working on some kind of a business plan to grow all their businesses very aggressively over the next 3-4 years. So again, I think it fits in very nicely with your thought process of staying invested in these for 5 years. So very clearly, I think all three are a hold for me.
3 are hold for you. And sir, you've also mentioned you want to buy Sun Pharma, Paris Defense and Welspun Corp. Is that still the plan? Do you want to ask that question, and the buy price you want to know from our experts?
Yes, entry price please, and IIFL can I average down?
Sure. Forum, would you like to guide him?
Yeah, so if I have to look for IFL Finance, the stock price has actually been in a down move. I would recommend that let the stock price give a good weekly closing above the levels of 480 because that is more of a resistance at the moment. It's a very crucial level because in Feb, when the stock price was falling from those levels of 675, it tried to hold up to those levels of 470. Eventually, it gave up and we saw it moving lower towards 420. So ideally, let there be a good weekly closing above 470 to 480, then consider getting into or adding into the stock. Until then, just hold on to the existing shares.
All right, with that, let's take a quick breather. We'll come back and get your questions answered. Stay tuned.
Welcome back. You're watching Buy Now, Sell Now, and it's time to once again get connected with the management. And we'll be talking about Smartworks that has turned to profit in Q4 year-on-year basis. Strong Q4 for Smartworks, and definitely revenue has soared up almost 45%. To talk more on this, we are joined by Harsh Banani, co-founder, ED Smartworks. Hi, Harsh. Welcome to the show, and congratulations. You reported a very strong numbers on an annualized basis. You have turned net profitable. Can you please tell us how long this growth is sustainable now? How are you understanding these numbers?
Good morning. Firstly, thank you so much for having us this morning. FY26 has been a landmark year for Smartworks. Not only it has been our first year of listing, but it has been a year of several firsts. As you rightly mentioned, we have crossed more than 1 crore square foot of operational footprint, which is the first listed flex platform to do so. And this is also our first full year of accounting reported profitability. While the company has been cash-wise profitable for the last 5 years, but the accounting milestone is also a major one. And as we now move forward into FY27, the company is already at a contracted rental revenue of more than 5,200 crores. So very interestingly, FY26 has not only proved the validation of the business model, but firmly driven our compounding thesis. So you have clearly seen that our growth is now upwards of 30%. Our margins have improved by more than 75% year-on-year basis. But most importantly, the cash flow and the ROCE profile of the company has improved very meaningfully. So you're seeing growth, margin, cash flow, and return all improve together. And that is where the story continues to get more exciting. As we now move into FY27, happy to share that more than 82.5% of our revenue for the year is already contracted. So to your question around sustenance of the current growth, we firmly believe more than 30% revenue growth is well on cards. We will end the year by adding another 2.5 to 3 million square foot of operational area. And we expect that our EBITDA, which closed at 17% for the entire year, but the quarter ended at about 19%, we expect to maintain that and rather improve on that. And we also expect that our ROCE will continue to improve fairly meaningfully from the trajectory it has taken.
Mr. Banani, hi, Ankita also joining in. How many seats have you added in FY26, and what is the seat addition guidance for FY27?
Sure, Ankita. Thank you. So FY26, the company had operationalized more than 2 million square foot, and we had sold a net seats of more than 40,000 seats. So the trajectory is now going to double in the coming year. So this year, we will end the year at close to about 12.5 to 13 million square foot of operational area from the 10 million square foot that we are currently at. And the sales velocity that we've demonstrated, largely because of the large GCCs we've signed up last year and the mega 1,000+ seater deals that we've done across the board in all the cities that we are present in, should augur very well for ramping up the occupancy of all the new capacity that we are adding in FY27.
All right, Harsh, what is the demand you are seeing in GCC segment now, specifically going ahead?
India firmly is the GCC capital of the world. And last year was able to demonstrate very clearly that not only is GCC coming to India in a very big way, but they've also chosen flex as a default choice. And going forward, we expect that another 16 to 20 crore square foot of GCC demand is going to come up in the next 3 years. And there are several reports which speak about how more than 40 to 50% of that is going to come to flex. So that is going to be one big demand driver. But if we had to just take a step back, India's total commercial stock is close to about 1 billion square foot, which, take it or leave it, is still less than New York in entirety. And flex space within this is about 10 to 12%. So we've become the largest category now, Ankita, in the world for this. And Smartworks has been growing significantly faster than the CRE industry, but also more than flex. So we've been gaining a lot of market share. And going forward, we expect that while GCCs will continue being a major demand driver, but we are also serving a lot of Fortune 500 companies. We are also serving a lot of new AI-led companies which have been absorbing a lot of space. So that's where the flexibility also comes. But most importantly, a lot of the traditional occupiers who are used to the long leases, 9-year conventional rigid leases, we are seeing a lot of rollover of contracts coming over. which is what gives us the conviction and confidence that while new companies, GCCs will continue to absorb space, but the more fundamental habit shift which has happened, which is to get traditional occupiers to move to flex, will also augur very well for a unique differentiated platform like ours.
Right, Mr. Binani. Thank you. On that note, we are completely timed out on this discussion, but it was a pleasure to have you on the show. We will quickly go cross and cut into the HUL presser. HUL that reported its quarter 4 numbers. Priya Nair, CEO and MD HUL, and Niranjan Gupta, who's the CFO of HUL, are now talking. Let's go cross and cut into here. What is the growth roadmap ahead for the company?
Format protein in select online stores in the quarter. You will hear more about that in the forward quarters. Packaged foods reported mid-single-digit growth, driven by Unilever Food Solution ketchups and mayonnaise. Kisan's expansion into chutneys is seeing encouraging early traction. Overall, for the financial year 2026, we delivered a turnover of 63,763 crores with 5% USG, driven by 4% UVG. The EBITDA margin for the full year was at 23.6%, remains at the higher end of the guidance, and absolute EBITDA grew 2% year-on-year, and our profit after tax before exceptional item stood at 10,324 crores. The board has recommended a final dividend of rupees 22 per share, subject to approval of shareholders at the AGM, taking the total dividend to rupees 41 per share. This translates to a total payout of 9,633 crores. Importantly, our growth trajectory strengthened throughout the year. We exited March quarter with 7% USG, accelerating against a 2% USG you saw in fiscal year 25. Over the last few quarters, we have taken a series of decisive actions to unlock this growth momentum that you see now. First, we crafted key priorities to drive volume-led growth. Secondly, we stepped up our omni-channel capabilities with the setup of a dedicated quick commerce organization while continuing to strengthen execution in general and modern trade. Thirdly, we are sharply allocating resources behind fewer and bigger bets, including the recent commitment of around 2,000 crores in capex towards premium format, which will get deployed over the course of next 2 years. Fourth, we have been more active in sharpening our portfolio through actions such as ice cream demerger, 100% acquisition of Oziva, and scaling up of Minimalist. And we've also reorganized the company under a unified India organization to bring agility in execution and speed in decision making. We are seeing encouraging results through these actions and are committed to stay the course. Our strong balance sheet remains our key strategic advantage. For financial year 2026, we've ended with the reserves of close to 49,000 crores and a cash flow from operations close to 10,500 crores, providing the flexibility to navigate volatility and invest in growth. Both return on capital employed as well as ROE improved 270 bips and 110 bips year-on-year respectively. Together, these metrics reinforce the robustness of our financial model. Before closing, as I said, let me briefly turn to the current external environment. The Middle East crisis has disrupted the global crude oil supplies, as we know, driving inflation in crude and crude-linked commodities. We've responded with strong operational discipline, leveraging our supply network to secure supplies, stepping up savings, calibrating media spends, and taking judicious pricing actions, all while maintaining an attractive price-to-value equation for consumers. In response to elevated crude-linked commodity inflation, we are taking calibrated price increase, as I said, across the portfolio in the range of around 2 to 5%, which may result in some short-term balancing between volume and price growth, although the categories in which we operate are less elastic. In terms of coming to the outlook, we recognize that the geopolitical tensions can create some short-term disruptions. However, our strong and resilient financial model, operational agility, and our ability with our local global supply chain, and our ability to navigate the P&L across the lines, and supported by our robust brands and portfolio, we are maintaining our guidance of FY27 to be better than FY26. We expect margins to be around our guided range, the midterm outlook which we had said, which is 22.5 to 23.5%. And while navigating this, the volume-led growth will remain our number one priority. With this, I conclude our prepared remarks and will now take questions.
Right. Thanks a lot for the opportunity. The fourth quarter, we saw a noticeable uptick across the consumer sentiment. So my question is a two-part question. One is on the demand environment. Has there been a noticeable shift in the demand environment for consumer companies to report better than expected numbers? Is this a one-off because of GST or is this structural in nature? That's part one. And the second part is on the operating environment. You do say that 22.5 to 23.5 is what your margin band will be. But as we speak, crude is at 124, 125. Raw material prices have only increased. And a lot of the companies have exhausted some of their low-priced inventory as well. Is there a risk in the next couple of quarters it may go below your guided band, even though for the year it stands?
So as far as demand outlook is concerned, we've seen uptick in demand. Okay. And that's been a continuous feature that we have seen over the last couple of quarters. We wouldn't say it's aided immediately by GST because GST has impact in FMCG categories over a longer period of time. So this should be a structural movement uptick in the demand as we see. When we come to the pricing and the guidance, we need to remember that one, we've already seen an inflation. We are seeing, let's say in June quarter, close to around 8 to 10% of our cost base. We are able to navigate through balancing between partly pricing, partly accelerating our savings program, equally calibrating our media spends and efficiency. We operate with a large, significant amount of media spends that we can optimize. And of course, as we go through with our portfolio and the pricing power that we have, we are confident of continuing to maintain the guided range of margin.
So just to follow up on that, because your media spends are likely to be, calibrated, that's not necessarily great news for media channels like ours, but you have a guided band on the kind of spends that you want to do as a proportion of sales on advertisements. And when you say FY27 is likely to be better than FY26, if you could say by what degree?
So as far as we don't give a number guidance, so we'll continue to say that FY27 better than FY26. I think it's important to recognize that this guidance reiteration comes despite the Middle East crisis. Because earlier our guidance was pre-Middle East crisis, and we have seen uptick in our December quarter and March quarter numbers, actual numbers, and we're still maintaining the guidance. So there is that confidence that we have backed up by our portfolio, that we have our pricing power, the demand uptick that we see as a combination. So therefore, that's the confidence that guiding our numbers moving forward.
And maybe I'll just add one thing to what Niranjan said. I think, we are in uncertain times. We're in uncertain and volatile times. But we remain confident for three reasons. One is the strength of our financial position, the operating agility we have as a large organization, our supply chain procurement strength that we have as a large company, and mostly because we have brands which we straddle the pyramid, right, from mass to premium, and really ensuring that we rotate our portfolio to where consumers go. So we remain confident on our ability to be able to do that while continuing to drive savings across the portfolio, including on product savings, media savings, but really that's business as usual. I think what's important to remember is we are best placed to really ensure that we navigate this short-term volatility, but remain focused on our long-term growth potential and really ensuring that we leverage that. So that's really how we will look at it.
Okay, so hi Priya, hi Niranjan, morning. I want to understand, first of all, at the parent level, the food business demerger has been announced. Now I understand there's been a clarification from HUL saying that we don't have any plans like that. Is that maintained? No plans for the food business demerger?
So I think it's important firstly to understand what is HUL's foods business. Our foods business in HUL is firstly a beverage business, tea and coffee. The second is it's a lifestyle nutrition business with Horlicks and Boost. In foods, Kisan is our largest brand, a big local jewel, culturally super strong in the country. And if you look at packaged foods in India, the per capita opportunity in packaged foods is huge. So we continue in HUL to remain focused, and we've clarified that HUL Foods is outside the perimeter of the transaction that was announced.
Understood. And also, in your remarks, you did mention 2,000 crore rupees investment to advance your premium categories. Could you help me understand what portfolios are you targeting, what some of these products could be?
Yeah, so these will primarily be, let's say, the liquids portfolio, and the liquids portfolio across home care, beauty, and personal care. So you could take, for instance, the body wash, you can take the liquid format in the detergents, the shampoos. So all of those is where the premium formats that we are talking about is where the capital expenditure will be. So it's again in the same spirit of focusing on fewer, bigger bets, and therefore participating more and more on high growth spaces, high premium formats as we move forward.
This is in line with your previous quarter commentary of fewer, bigger bets, because I remember asking you that last quarter.
Absolutely. So the capital allocation continues to be in line with the stated strategy.
Understood. Lovely.
Hi, good morning, Priya. Hi, Niranjan. Congratulations on good set of numbers. My question is on volumes, because this time it's a 15-quarter high number that you've seen, right? Considering that you've said that you will be taking, calibrated price hikes, that could impact volume going forward. But at the same time, you've also said that, volume growth is our top priority. So going forward in FY27, I know you will not talk numbers, but any range in which you'll be seeing volume growth coming forward?
So firstly, we won't offer a short-term guidance, right? Yeah. But let me get into firstly, what's the step up we are seeing? Yeah. I think the first thing is, what are we working on? First is fewer, bigger bets. We've talked about this before. We will continue to focus on scaling up a few priorities so our resource allocation is becoming sharp. So that's the first thing. The second is working on our brands, modernizing them, premiumizing them, both in terms of communication, but also in the segments in which our brands play. Creating higher exposure to the higher growth segments is what we're working on across all our brands. Remember, HUL, we have 20 large brands and 55 total brands. So across our brands, really systematically ensuring that our brands, we step up. The third is in terms of building the capability of our channels, really doubling down behind execution, because it's much more an omni-channel market, India, than ever before. So whether it is QCom, e-commerce at the top, or actually we are now investing also in general trade. So we're actually investing in building our footprint in chemist channels and open format general trade stores, and we have created a new specialized force to go to market in these channels. That combined with continuing to drive our leverage, our operating leverage, is what sets us up for the next year.
All right, so that was HUL management elaborating more on the numbers, and the Q4 numbers actually beats the estimate. The stock down almost 3.5%. But then with that, it's also time for a short break, and post that, more stock-specific action coming up. Stay tuned.
Welcome back. You're tuned in to Buy Now, Sell Now. We're talking about the markets, and let's talk about the trade deal between India and Chile then, that are in talks, and it is back on the table, back on track, with both the sides aiming to conclude a comprehensive pact in the next 2 to 3 months. Chilean delegation is expected in India in May, with discussions focusing on key priority access clause for critical minerals. My colleague Sumita Karir is now joining us with the details of this talk.
That's right. Exclusive sources are telling ET now that India-Chile trade talks, that they are back in focus, and in fact a trade delegation is expected to be in India in May for further negotiations. And in fact, both sides are looking at closing and concluding negotiations in the next 2-3 months itself. In fact, as far as these negotiations are concerned, this pact is concerned, a special chapter asking for priority access to critical minerals. It's going to be part of this pact. And in fact, when we talk about priority access, this is going to be related to sourcing, processing, and and mining of critical minerals. In fact, India has also made a key demand as far as local value addition locally is concerned, and India has asked that there should be no conditions for value addition locally. In fact, for the same 2-3 institutionalized mechanisms, they are part of the pact, and they are likely going to be put in place to ensure that there are no sudden roadblocks in supply chains that's related to the critical minerals chapter. In fact, the understanding on the side of the Indian government is that India will not have much to gain if this special chapter is not part of the deal. So, of course, there's special focus on this particular chapter. And if we do see the developments, while Chile's Vice Minister of Trade met with India's Commerce Secretary Rajesh Agarwal, this happened on the sidelines of the WTO ministerial in Cameroon. In fact, the CIM, Piyush Goyal, he also had a VC with Chile's foreign minister. So, of course, trade talks are back in focus. And we're given to understand from sources that CEPA, this trade pact rather, is a pact of high priority for Chile, and it is looking at India as a trusted and an important partner. India has, of course, stressed the importance of a fair and balanced FTA. Now, if you remember, a couple of weeks back, both sides were looking at targeting an early March timeline to conclude the trade deal. However, there were elections that were happening in Chile, because of which these trade talks got stalled or got delayed for a bit, but they're back in focus. The overall pact is going to cover digital services, investment promotion, and critical minerals, and India is expecting complete market access to Chile. In fact, we had a PTA with Chile when it was signed in 2006, and that PTA is going to be converted into a larger trade deal wherein India's interest in exporting pharma, engineering, auto components, textiles, and autos will be in focus. In fact, Chile's interest lies in India's copper and agricultural markets.
So, Nira, thanks so much for all those updates. But then let's move on. Bajaj Finance reported an inline Q4 with the net profit rising 22% and NII up almost 20% year on year. The management remains optimistic on FY27 growth, guided by new businesses and accelerating AI-led transformation, though margins may see slight moderation. Mithali joins in with the management commentary and street verdict.
Right, talking about Bajaj Finance, the company has reported a strong and largely in line numbers for Q4 FY26. The net profit has grown nearly 22% on a yearly basis, supported by robust loan growth as well as steady margins. There was also a drop in the credit cost to 1.6%, and management expects this trend to continue for FY27 also, as the company has given the credit cost guidance to be in the range of around 1.45 to 1.6%, reflecting rising confidence in the normalization. The AUM grew around 22.5%, while the asset quality also strengthened. The provisions declined both on a sequential as well as on a yearly basis, aided by normalization post the elevated ECL provisioning in the earlier quarters. The margins, they remain stable in Q4, though management has guided for a slight NIM moderations going forward. The PPOP, it grew around 21%, indicating continued operating strength. Looking ahead, the company is guiding for the AUM growth of around 22 to 24% in FY27, with profit expected to grow slightly faster than the loan book. This will be supported by margins, better operating efficiency, and a more benign credit cost environment. Management also highlighted the improving operating leverage, with AI-led efficiency expected to drive a 25 to 40 basis points improvement in its cost ratios. So overall, Bajaj Finance enters FY27 with a strong momentum, better credit performance, and also a clear focus on the profitable growth.
All right, thank you so much, Mithali. But then let's take a look at the market also. The markets have definitely tumbled, with Nifty almost at 23,827, down 1.5%. That's the same with Bank Nifty. If you look at the broader market, even that's down 1.5% on the index side. Small cap and mid cap 100 both down almost more than 1%. Sectorally also, we are looking at most of them in red. Metals, PSU banks and realty face the sharpest pressure so far, and a risk of a sentiment that's been signaled in the market. Defensive pockets like IT and pharma relatively resilient, but yes, we are looking at the redness increasing out there also. Metals almost down more than 2%, reality more than 2%. Across the board, we are looking at a sea of red. Now, the mood is definitely cautious with a very weak momentum in the market. But if you look at some stock-specific specific action. Let's look at Syngene now. It's almost 8%. The full year guidance on revenue and margin has really beaten the estimates that has come up in the Q4 earnings. The stock is almost up 11.5%. We are looking at full year guidance in Q3 was revised to a 3 to 5% revenue decline with EBITDA margins of 22 to 23%. And FY26 revenues stood almost 3% up year-on-year basis with the margins at 25%. So that's what on the market so far. So yes, we'll be keeping a track on that. But it's time to wrap up this edition of Buy Now, Sell Now. Post that, let's get you markets at noon. Stay tuned.